how do you remedy a short squeeze? Well, you supply some physical into the market, but who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone onto the critical minerals list, or at least it's been recommended, so it's unlikely that the US government will come to the rescue of London on this one. China, are they going to come to the rescue? I mean, in the past, they have suppressed the price. Of that, there is absolutely no doubt. But it seems to me they've withdrawn from the market. And not only have they withdrawn on silver, but you can see from their policy on rare earths that generally they're withdrawing from supplying needed metals and commodities from the West.
Alasdair Macleod explains that the current silver market crisis stems from a severe liquidity squeeze, more visible in silver than gold. Massive withdrawals of leased gold from the Bank of England to New York have exposed how dependent the system is on rehypothecated metal. Now, central banks are pulling back from gold leasing, threatening the liquidity foundation of the bullion market. Unlike past hidden crises, this shortage is public, making it difficult for authorities to manage. Neither the US nor China is supplying silver. Both are holding tight, with China also cutting exports of key metals. Meanwhile, physical demand from investors has surged, overwhelming dealers. Macleod concludes that rising metal prices reflect not just scarcity, but the falling value of fiat currencies, signaling deep stress in the global monetary system.
What we're seeing in the markets at the moment is a squeeze on lack of liquidity. It's very obvious in silver. It's less obvious in gold because you're not getting the high lease rates and backwardations between London and New York. But nonetheless, there is a squeeze in gold because following earlier this year, when masses of gold were taken out of the Bank of England vaults, basically, to arbitrage into New York, a lot of that was leased gold because, the principal storers of gold in the Bank of England are other central banks. And the Bank of England has always encouraged other central banks to lease their gold as part of providing liquidity in the London gold market. Now, when you see it actually disappearing out from under the Bank of England's control, you wonder if you're going to get it back. So I really do think that central banks as a whole are withdrawing from the gold leasing market. Now, this is very important because it's been leased gold, which has been hypothecated, rehypothecated, rehypothecated to keep the whole system, sort of swimming along. And without that leased gold, we're going to end up with a bit of a crisis. And the other thing which I was sort of thinking this morning, Alex, is that we've had problems in the past in the bullion markets, but they've never been publicly aired, if you like. Only sort of well after the event, you hear that so-and-so had to be rescued or whatever. There was I can't remember that there was a bullion bank way back in Eddie George's days, and I'm going back to, I think, sort of very early 2000s when he had to sort of disappear off from a meeting or from smoking a cigarette outside the Bank of England. Because he was a wonderful trader and a really, really good guy. He had to go and help rescue this problem. This just doesn't happen now. I mean, we just don't see it. But suddenly, yes, we do see it. It's all over the press. Everybody knows about, that there's a shortage in physical in the silver market. I mean, they come up with different conclusions as to how to resolve it and what is likely to happen and all the rest of it. But this is a new thing that's become very public, and it must make it very difficult for the authorities to manage a crisis, if you like. I can't see really how this crisis can be easily managed. I mean, in the past, there wasn't, if you like, the sort of current overall level of indebtedness. You had speculators, if you like, driving prices. But if you look at the open interest on COMEX, the speculators are not there. I mean, this is all short squeeze. And how do you remedy a short squeeze? Well, you supply some physical into the market, but who's going to supply the physical into the market? No, not even the authorities have got it. You could argue that the United States might have some concealed silver reserves, but that's just gone onto the critical minerals list, or at least it's been recommended. So it's unlikely that the US government will come to the rescue of London on this one. China, are they going to come to the rescue? I mean, in the past, they have suppressed the price. Of that, there is absolutely no doubt. But it seems to me they've withdrawn from the market. And not only have they withdrawn on silver, but you can see from their policy on rare earths that generally they're withdrawing from supplying needed metals and commodities from the West. So you can see that suddenly, where's it going to come from? And reports that I've had 2 reports in the last few days of enormous demand for silver and gold. I don't know, this is something you could probably comment on, but the dealers in bullion have been absolutely inundated with orders from private clients, from small people, and suddenly, they are just incredibly busy. I mean, I had I was meant to be doing a podcast earlier on this morning, but the people I was doing it with phoned me yesterday and said, "Look, do you mind awfully if we put it off because we're so busy, we just haven't got the time to do it." Yeah. So this is new, and all this publicity is just driving extra demand. People are just getting in because they haven't got any. So they're trying to get into these bullion markets. So coming back to your question, I mean, there is no doubt that what's going on in the markets at the moment is specific to precious metals, driving up their values. But this is against a longer-term background of what's really happening, and that is it's the values of the paper currencies falling rather than the values of gold and silver rising. Though this squeeze is actually changing that relationship quite a bit.
Alasdair Macleod explains that the recent rise in gold prices, despite stable or declining open interest on COMEX, signals a short squeeze rather than speculative buying. Technical indicators like RSI are misleading because they ignore the real market dynamics. Paper traders are being forced out as physical demand tightens. He warns that the disconnect between paper and physical markets reflects a deeper issue. The global fiat currency system is breaking down. Fiat money, he argues, always collapses under excessive debt and unlimited issuance. Governments continuously print to sustain spending until confidence is lost. The growing strain in precious metals markets is, in his view, the first sign of this collapse. With hundreds of trillions in derivatives built on fiat currencies, gold and silver are acting as the canary in the coal mine, signaling the approaching end of the current monetary system.
Well, I think what you've got to look at is the relationship between speculation and changes in the price. I mean, COMEX is an openly visible market on this one. When you see the price rising and open interest either not following or even contracting, that is a clear sign that the bears are being badly squeezed. And if you look at the level of open interest in gold, it's around about 480,000 contracts, something like that. That's not overbought at all. Yet we've been, as you said earlier, we've been hitting new highs day after day after day. So where's the overbought? It's not overbought. Okay, you look at the RSI indicator. Chartists will say, "Oh, that's overbought," and all the rest of it. But they're looking at the wrong thing. Man does not survive by charting alone. You've actually got to look at the market. So this is a very, very difficult situation for market makers in particular, in futures markets and also in the forward markets in London. I mean, I think in the broader context, what we are seeing is, if you like, the relationship between paper and physical becoming very, very strained. And I think it's a symptom of the end of the fiat currency system. We are beginning to see that the fiat currency system is in huge, huge, great difficulties. Of that, there is no doubt. And fiat currencies don't last forever. They've always got a limited span, and they always collapse, and they always collapse in the same way. They collapse basically because there's just too much debt. The debt just mounts up and mounts up. I mean, the whole point of a fiat currency is you can issue the thing, without constraint. So obviously it gets issued without constraint. So that means there does come a point where the fiat currency can be no more. We've seen, I mean, every collapse of a fiat currency is really from that sort of, from the overloaded debt, the accumulation of debt, and if you like, the dependence of governments on issuing yet more and more currency, because they've done it before, and it's their right to do it, and who dare interfere with us is financing your government. You've got all these sort of arguments in favor of the eventual destruction of fiat currencies. And I think, Alex, that's where we're going. To see what's going on in the metals markets, I think is the first sign of that. And I wouldn't be surprised that this is the first sign of it. Because the problems, I think, in derivatives, I mean, we're talking about, quadrillions, really. Well, not quite quadrillions, but we're talking about, I don't know, sort of $600 trillion notional of derivatives. And, that basically is all built on fiat currencies. And if fiat currencies are coming to an end, this is the canary, if you like, in the fiat currency mine. It seems to me, and it starts with gold and silver and spreads maybe through other commodities, and then maybe into foreign exchange transactions, for example, and so on. So, that's where we are, and it's I think signaling that things are going to get very, very difficult for everybody.
Alasdair Macleod warns that both gold and silver markets are showing clear signs of deep structural stress, a symptom of the global fiat monetary system nearing its breaking point. He explains that the surge in metal prices isn't driven by speculation, but by a severe shortage of physical supply as central banks withdraw from gold leasing and liquidity dries up. This has created a real short squeeze in precious metals, with demand from investors and the public overwhelming available supply. Meanwhile, major suppliers like China and the US are no longer providing relief. Macleod argues that these events mark the early stages of a global currency crisis. Fiat systems always collapse under mounting debt and endless money creation. The widening gap between paper markets and physical reality in gold and silver is, in his view, the canary in the coal mine, signaling the approaching end of the fiat era and a shift back toward hard, tangible money.